This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 18 deals with some current developments in performance management. And we've started here just with a brief reminder of the work of Burns and Scarpins. We did this right at the beginning of the course. And it's just recognizing that management accountants are no longer just logging costs and doing variance analysis. They are much more involved now into providing information, helping people with decision making and the like, than simply recording what costs were. And the changes that have pushed this alterations through, there's a change in technology. A lot of basic costing and cost recording is now done automatically. Management structure has changed. It tends to be much flatter now. More people need more information, more people are involved with decision making. There's probably greater delegation going on and greater competition. Everyone needs to help in deciding what the company should be doing, what the organization should be attempting to achieve. The pace of change is much faster. Technology changes faster, the competition changes faster, products change faster, what customers want change faster, and it's really all hands to the pump to help organizations stay up amongst the leaders. The first topic we then really look at, first new topic, is quality. Quality is quite important in this syllabus. And it's really looking at how good quality might improve the performance of a business. What you have to be careful of is to say that quality is an end in itself, that we must always aim towards the highest possible quality, because quality normally has a cost associated with it. Often the higher the quality, the higher the production costs. And what we have to do is to ensure that we get an appropriate quality and that people get the quality that they expect to get for the money they pay. We all know, for example, if we're buying a shirt, there's a bit of a choice. We can go for a relatively expensive shirt, maybe for a special occasion, and we expect that to, last for a long time and to wash well and to keep looking smart. Sometimes we just want a cheap shirt, maybe for going on a holiday or leisure wear, something of that sort. And we spend much less money on it, and we're not really surprised, we don't feel cheated if it doesn't last quite as long. So there's no absolute level of quality which we're aiming at. And here is a couple of definitions. Quality is fitness for use. And this depends on the user. And secondly, the quality is the totality of characteristics and its ability to satisfy customers' stated or implied needs. And again, it is all related to the customer. Quality is really in the eye of the beholder. It is for the customer to decide whether or not the quality is good enough, particularly looking at the price that may have been paid. A couple of initiatives on quality. There is ISO 9000, there's a range of ISO 9000s here. ISO is International Standards Organization. And what this ISO 9000, 9001 and so on are aimed at is a system, a quality management system to produce consistent standards. It is not aimed as such at improving quality. What it is aimed at is really saying that if a company says that only 1 in 1 million of my products is going to fail, that you can back that up, that you have got controls, tests, procedures which consistently ensure that no more than 1 in a million are going to fail. So it's looking not at products to see if they're good enough, it's looking at processes and systems to see if they're good enough. And what happens is that you have to design and document a quality control, quality assurance system. So you would be saying right from the very, the purchase, how do you know you're purchasing raw materials of adequate quality? I would expect you to maybe go and visit the factory of your supplier. It would expect you to inspect the goods as they come in to make sure they were of adequate quality. It would expect you to train your staff to have sufficiently modern machinery to be able to deal with the tolerances and so on. It might expect you to test all of the items coming off, or maybe 10% of the items coming off, or 2% of the items coming off, whatever was thought appropriate. And it might then expect you to store and deliver these products in a way that doesn't damage them. But this isn't going to happen automatically. There has to be procedures. It's a bit like accounting procedures. You say, this is how you get something authorized, this is what you must match, this is how you're going to record it, and so on, in an internal control system. Basically, we're looking at a kind of internal control system for quality to make sure that the quality standard is, whatever that is consistently obtained. The way a company gets this is it has to, as I say, it has to design and document and implement its quality control system, a lot of training in there, and then it gets an independent quality assessor or expert to come in who will look at the system and really examine how it is being implemented, like a quality audit going on. And if satisfied, then the certification will be awarded and the organization can register under the ISO 9000. There had been a great push for these ISO 9000s over the last 20 years. And it has to be said, they are often bitterly resented. Many governments pushed companies to do this, but the government said, we will not buy from you, and governments can be a very, very important purchaser. The government said, we will not buy from you unless you possess these ISO 9000 certifications. And it meant that many relatively small firms who were producing goods of excellent quality had to go through a very long bureaucratic procedure of recording and having audited their quality control system, and the quality of what they were producing just stayed about the same. But what they could do is they could prove a kind of consistency in it. And to some extent, whether you're a large firm or a small firm, designing and implementing, documenting a quality system, it's not going to be much more expensive in a large firm than a small firm. So proportionally, there was quite a big burden in these small firms, yet it produced goods of not much additional quality. The second initiative which we'll be coming on to is the idea of total quality management. But we'll start here with this, what looks like a remarkable claim here, that quality is free. In the 1950s, 1960s, certainly in a lot of American industry, particularly maybe the car industry, a lot of the UK car industry, there was this assumption that if you make a car of higher quality, it is going to cost more, it is going to reduce your profits. And some awful junk was manufactured. And it took really the Japanese to come along and show American and particularly British manufacturers that quality was actually quite important. Now, how this works is it breaks it into what are called conformance costs and non-conformance costs. Non-conformance costs is when something kind of goes wrong, okay? And what we'll start off is thinking about an organization which has got no quality control whatsoever. It just produces goods, doesn't look at them, test them, doesn't do anything with them whatsoever. And out they go to the customer. And of course, a certain proportion of them will fail with the customer. And that's known as an external failure cost. And that is going to be pretty serious, pretty high cost. The customer is going to be really fed up. You maybe have to bring the goods back, see if they can be repaired. You have to replace the goods perhaps to keep the customer happy and so on. There's a lot of ill will and loss of goodwill going on there. This is the most expensive way of dealing with quality. Quality failures at the customer. Maybe instead of relying on the customer finding all the problems, what you do is you build the product. Let's say it's a television that you're building here. And what you do is you haven't done any really quality control, but just as it's finished, you turn it on and you let it run for 2 hours to see if it is working okay. And a certain proportion, of course, will fail, but to fail with you rather than being failed at a customer, and that's called internal failure cost. That will not have quite the same devastating effect as it would if it fails at a customer, but it's quite expensive because you have a whole television set. It doesn't work. You have to find out why doesn't it work, a lot of fault finding. You then have to see if you can take it apart and repair that, and whether or not in fact the repaired goods are worth selling. So it's quite expensive, but less expensive than failure with a customer. Instead of waiting until the television is complete, what we could do is test it at each stage. So every time another component or another piece of stage of production is carried out, we do some tests. We do some electrical tests, etc., to see if it is still working. And of course some things will fail there, but if it worked okay at that stage and doesn't work okay when the next component is being put in, there's a good chance that it was that component that doesn't work, or that operation that was carried out badly. And we don't have to take the whole thing apart. We can probably repair it much more quickly. So it'll be even cheaper. And the goal is to prevent anything going wrong at all. If you can prevent anything going wrong at all, this is the cheapest way of achieving quality output. And it may mean that instead of beating your suppliers down to the lowest possible cost per unit, you pay another 5 cents per component, but these components come and they're all going to work, you know. You spend a bit more on training your staff so that they don't do things wrong. Maybe by the way you design products, you design them that they in a way won't go wrong. So if it's something very simple that you have to plug something in, make sure it can't be plugged in the wrong way, that it's actually impossible to construct the article incorrectly. Have better machines. Make sure they're regularly maintained so that items coming off the production line are as perfect as they can ever be. So moving the effort up towards the beginning there is going to save costs, and that's why quality is free. The costs down here are huge. The costs up here, putting a little bit more effort nearer the start, are going to be less. So quality ends up being free. Total quality management is a philosophy or culture. There is the idea that it's never going to end, that we're never going to be satisfied, that we're always striving to get higher quality. And it's not just in production, it's in everything the organization does, from answering the telephone properly, from giving the right information over the phone, to raising invoices accurately for dealing with receipts of cash from customers correctly. Everything you do is as perfect as it can be. It focuses on preventing things going wrong. Okay, if you don't prevent them going wrong, catch them, but we want to stop things going wrong to start with. So training is very important. Kaizen approach, again a Japanese term, it means making small incremental improvements. Okay, little by little, Never give up. But there's always going to be something you can do to improve. And indeed, many standards are set using a Kaizen approach. If we were able to make something in 2 hours last year, maybe what we could do is make it in 1 hour 50 minutes this year. If something took 2 kilograms of material to make last year, maybe we could make it in 1.95 kilograms this year. We gradually try to tighten up these standards through this continuous improvements. It requires a lot of analysis to see where things may have gone wrong, what we need to attack to get the next small improvement. And it requires great long-term employee involvement. Total quality management is not something which can just rely on management kind of imposing here. It has to be within the culture of the employees that they don't want anything to go wrong. They are embarrassed if something goes wrong. There is a pride in their work, there's a pride in what they're producing and how they're serving their customers. A way of getting towards, I suppose, total quality management is what's called the Six Sigma approach. This was an idea that was invented by Motorola. Motorola makes microcircuits, microchips for computers and phones and so on there. And they were interested in getting very, very low rejection rates in the manufacturing. We don't worry too much about this 3.4 defects per million. We said at the start that quality is a kind of movable measure. It depends what you want. But they were anxious to get this very, very, very low rejection rate. And that's what we're trying to get through Six Sigma. And it produced a kind of a methodology, I suppose, at how we could gradually crawl away towards very low rejection rates. And the first thing it said is, you must define what you mean by quality. If you don't define what you mean by quality, we've no idea where we're getting. So if it was in manufacturing a product, it could be that the product is going to last for 10,000 hours without failure. That would be quality. Or it could be that the product is made to a specification within a fraction of a millimeter. Maybe that's what they mean by the quality in some manufacturing. If you're providing a service to people, that's a little bit harder to define, but you have to try to your best to define what do we mean by providing good service to our customers or to our clients. And then you have to measure that. You have to measure the failure rate. You have to measure the accuracy with which you're producing goods and so on. You have to measure how good the service is that you're providing towards clients and customers. Then you analyze what's gone wrong. So we're assuming that we have a slightly high failure, that some of our customers are less pleased with us than we'd like. We have to analyze how come that's happened. And what you do is you think about it and you try to improve it. You say you have analysed it, you think you've spotted what's gone wrong, and you put through a change of operations, a change of methodology, and hope that it's going to go okay. And basically what we've got going on in here is a cycle, yeah? So you improve it, and you measure it again. And then you analyse what's still going wrong and so on, and you improve it again and so on. And you may have to, through control here, you may decide that what we'd originally kind of defined as good quality is maybe too hard. It's going to be maybe too expensive or too slow to get there. But we have to control the process to make sure that the costs are not becoming too high, to get perhaps a level of quality which is too difficult, which has been set actually higher than your customers want. So little by little you are going to be getting towards, it is hoped, the required level of quality. A little bit here on just quality software. How do we know if we have got good quality software? And I think what you just need to think about is the 5 areas here. it has to do the right things, function. It has to be reliable, and if somebody's selling over the internet, it has to be more or less 100% reliable 100% of the time. It has to be, the usability has to be okay. People don't get confused, and the menu options and so on. You can get quickly to what you want to do. The build quality has to be good, so it can be easily. It again is robust and can be easily amended and extended without causing errors in some part of it. And scalability. Many businesses start relatively small, perhaps only trading in one country, so maybe only with pound sterling, and then they begin trading in Europe, so you need pound sterling and euros, then America, so you need 3 currencies and so on. If you want your software, if possible, to be capable of growing with the business, because if you have to start with new software, then it's really quite expensive. Next thing we look at is life cycle costing. And the old method of costing tended to look at what does it cost to make each unit. It would look at the material that would go in, the labor that would go in, and it would then absorb some overheads into that and so on. What life cycle costing says is that that's only part of the cost to produce a product. There's lots and lots of cost before it actually gets into production. And then in many situations, after production stops, there are ongoing costs for a little while, kind of end-of-life costs, if you like. And here we have a diagram. It divides the time into 3 phases: the design of the product, the actual manufacturing and operations phase in the middle, and then a kind of end-of-life phase. So the end-of-life phase might be cleaning up the factory, cleaning up the land around the factory, perhaps demolishing the factory and returning the land to a kind of green site again. If we look at this bottom red line here, this is looking at the costs which have been incurred. So incurred pretty gradually. It could nearly be a straight line here, but the design phase, we're paying people to design the product and so on. A couple of designers working maybe for a year, relatively modest costs, and then we have maybe quite a long production phase in here. Nearly linear costs. The more units you produce, a lot of these costs are just going to be marginal variable costs there. And then what we have at the end is sometimes quite substantial end-of-life costs. Depends very much on the business, but if you were a nuclear power station, then the end-of-life costs, keeping the defunct nuclear power station safe for the next several hundred years, is going to be a considerable cost. But what life cycle costing gets at is committed costs as well as costs incurred. Committed costs are kind of costs you are nearly locked into. And really what it says is these committed costs go up very steeply at the design phase. It's saying if you design an item which is difficult to make and which requires expensive components, it doesn't matter how efficient you are at producing that item later, you are locked into, you are committed to quite high costs. So what it says is life cycle costing here. And also, if you set up the factory in a kind of conservation area, and part of the contract with the local authority to get planning permission is to say at the end of 20 years, you have to put this factory back, demolish it, put the land back to nice green kind of land again and so on. You're locked into that right at the start of the project. You're committed to this end-of-life cost. And what it suggests here is you need to think very carefully in these early phases here, because early decisions are really going to restrict what you can do about costs later on. And it pays to spend more time, maybe spend more effort getting the design phase right, because if you don't do that, you are inevitably going to be having a very messy and expensive production and end-of-life phase. Target costing. If you like, almost the way traditional costing used to work is you'd say, right, the cost of the product I'm making is 90. It would say we want a gross profit percentage on sales of 25%. So that would imply the selling price is 120. Because the profit in here, 25% of that is going to be 30. So we have costs of 90. We have a markup of 30% or a gross profit percentage of 25. And this is going to imply that we're making goods which we'll try and sell at 120. That is not target costing, that's conventional costing. The problem with target costing is you end up with this selling price of 120 without paying very much regard to maybe what competing products are selling at. So the way target costing would go about it is to look around and say, right, what do equivalent products currently sell at? And let's say it's 100. And then it says, right, the maximum selling price we can get is 100. We still want a gross profit percentage of 25. Therefore, the actual cost should be 75. So you say, how can I get my costs down to 75? Could I make us maybe a slightly simpler product that would still sell for 100? Could I perhaps buy materials in bulk that gets my cost per kilogram down? Could I go for very large production runs that gets my costs down? Could I perhaps offshore? Could I get the items made in an area of the world with lower production costs, lower labour costs? That may be a way to get my costs down. So target costing is effectively saying, this is your target, okay? This is the maximum cost we sustain, and you have to work towards getting that. Otherwise, we cannot at the same time get a decent profit and sell the goods. Environmental management accounting is becoming big issues, really. And it's a big issue for the following. First of all, there are more and more legal requirements over say, disposal of rubbish, over the release of gases into the atmosphere, or the releases of chemicals into rivers and so on. And if you don't comply with these legal requirements, you may have to stop trading, you may lose a license, there may in any event be very large legal charges. There's public relations. Many firms boast that they are ecologically or environmentally respectable, and if somebody is not seen to be doing well by the environment, then that's a lot of bad publicity they can be getting. There is ethics itself. We should try to do the right thing for perhaps our children. And there is cost. Not looking after resources is just costly. And I'm not even talking about the fines that may be there, but heating. Well, okay, oil prices have recently come down and so on, but by and large, heating costs were going up, the price of gas might be going up, the disposal of waste, the charge for that is going up, and commodity prices might be going up if there's more competition for them, so you don't want to be wasting 20% of your raw materials. So all good reasons why we want to look after resources. The costs that we can see, well, there are simply conventional costs. Conventional costs would be like the cost of heating the factory. Okay, so it would make sense if the factory's on holiday for 2 weeks or the weekend to turn off the heating. It would maybe make sense to insulate the factory so that those costs are reduced. Potentially hidden costs, but lost in overheads. An example of a potentially hidden cost is the so-called normal loss. So if you have 100 kilograms coming in, and they cost 10 each. We have there like 1,000. If your normal loss is 20%, you're going to end up with output of 80 kilograms. And what we're doing in there is really saying each item being produced is costing $12.50. In a way, you have concealed almost this loss. It's the cost of this loss, the 20 of this, is being spread over the other units. So that's been lost in overheads, really, or lost in your accounting methodology. There will be contingent or clean-up costs and compensation if something goes wrong at the end. And then there are image and relationship costs. Image cost is the goodwill or the damage to goodwill that you might get. Relationship costs are costs where we are going to some trouble maybe to produce promotional videos or promotional literature, showing people how careful we are with resources and what great care we take of the environment. Techniques that can be used in environmental management accounting. First of all, activity-based costing. We saw an activity-based costing, you have to understand the cost drivers, the cost causes. And you can't possibly control costs properly unless you understand what causes those costs. So we need to analyze what causes wastage, what causes perhaps heat loss, what causes effluent to be discharged into rivers and great fines then to be levied on us and so on. Input-output analysis is basically weights. You measure the weight of raw material going in, you measure the weight of raw material going out, and the missing raw material is something you want to be looking for. It might be inevitable, it might have to evaporate, it might be filtered out and so on, but nevertheless it represents a physical loss of mass, and we should be trying to reduce that if at all possible. Flow cost accounting. I must admit, I've never really understood this. I have looked at articles in Student Accountant by the examiner, I have Googled it, I have looked at philosophical works and religious works. None of them has satisfactorily told me what flow cost accounting is, other than it seems to be input-out analysis, but instead of looking input to the firm, output to the firm, you look at input to that department, output to that department, input to the next department, output to the next department, and so on. I would just remember it, okay? I don't think you're going to get ever any terribly good explanation for it. And finally, life cycle costing. If you create a factory with bad insulation, or you put in machinery which is very power hungry, or you put in machinery which is inefficient, or which releases a lot of gas and produces a lot of waste and so on, you are locked into high wastage. And high wastage will have a cost. So life cycle costing would say, at the start, try to sort out this environmental management accounting. Make wise decisions at the start, and these will probably pay you back later on down the line. Here are the suitable questions for Chapter 18.